times. Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to U.S. Markets Wrap with me, Ryan Huang. And we've got a new high yet again on Wall Street. But diving a bit deeper into the numbers, the S&P 500, just by the slimmest of margins, squeezing out a small gain of 0.03% to 6,488. On the flip side, we've got the Nasdaq Composite slightly lower by 0.01%, or pretty much flat, and the 30-stock Dow also pretty much flat, and that's down 11 points or 0.02%. Markets reacting to the latest producer price numbers, which suggests that the Federal Reserve rate cut is far from guaranteed. Now, let's break it all down with Jason Britton. He is the founder and CIO for Reflection Asset Management. Jason, good morning. How are you doing today?
Good morning, Ryan. I'm well. How are you?
I'm doing good as well. Now, Jason, the last time we had you on about a month ago, markets were hitting new highs, and that was a second day in a row. And today we've got it for a third day in a row, the S&P 500. But what do you make of what's playing out right now? Are we seeing a bit of a loss in momentum where we are not really seeing a lot of conviction behind the moves, at least in the latest session?
That's right, Ryan. Traders in the United States are having trouble right now parsing the data because we're getting mixed signals. Earlier in the week on Tuesday, we had the consumer price index, and that number came in better than people expected, suggesting that U.S. producers were absorbing more of the tariffs rather than passing them on to consumers. And then today's print of the PPI being higher than expected. The reality is that Americans really aren't sure what they're going to get when they go to the store these days, and it's reflecting itself in the bouncing around of the stock market.
Yeah, so those numbers, wholesale prices rising 0.9% on the month, much more than the 0.2% which the market was forecasting for. Are you seeing that play out in the latest earnings season with the commentary and some of the earnings numbers?
So the earnings numbers have been surprisingly strong, but what has been disappointing is that many companies have been withdrawing guidance, or they have been shading guidance and expectations and earnings for the third and fourth quarter down, and they've had a convenient excuse to blame, which is the uncertainty around tariffs. So it really is a market that's reacting to the news day by day, headline by headline.
Yeah, talking about headlines, we've got the U.S. Treasury Secretary making for his call for a jumbo rate cut in the next meeting. In fact, he's calling for 1.5% percentage cuts this year. What do you make of it? Is that justified with what we are getting?
So the reality is, no, I don't believe it's justified. I mean, in the States, we refer to there being dovish cuts and hawkish cuts, and that would be a pterodactyl-sized cut. 150 basis points would be virtually unheard of. And it's also unheard of that the Treasury Secretary injects his opinion. That's usually done by the Federal Open Market Committee and Federal Reserve Chairman. So it's unusual for the Secretary to be commenting on it. And as you can see, there was backlash throughout the day on the social media side of things, where towards the end of the day at a press conference, he was taking questions and actually walked it back, saying, well, he wasn't suggesting that we cut 150 basis points, just that some models suggested we might consider it. So it's another case of the administration leading with its preference and trying to telegraph what it expects people it believes are under its control to do. And then when there's broad market pushback, like we saw in response to the tariffs early on from the bond market, or in this case, broad pushback from the marketplace in general around the Treasury Secretary, they started to walk it back. So the taco trade is not dead. It's now just spreading from President Trump to Treasury Secretary Bissett.
Yeah, so a lot of political pressure from the administration on the FOMC. So that brings to mind what's going to be happening next month when we do get the meeting playing out. What are you expecting on that front? And of course, this is in the backdrop of how perhaps increasingly we are seeing the committee being more divided. We did see 2 no votes last time.
That's right, Ryan. So for the first time in 30 years, there were 2 members of the committee who actively voted no and dissented, which is almost never done, as I said, first time in 30 years. You have the governor's meeting right now that will be held at the end of August in Wyoming. It's the Fed, their sort of Jackson Hole Summit, and that's right before the September meeting. Tuesday of this week, the September meeting was pricing in something like a 50-50 chance that it could be a cut up as high as 50 basis points or 2 25 basis point cuts. That's all but gone down. There's still right now the market is pricing in, when you look at puts and calls, a 91% chance of a rate cut in September, but that's all but certain now to be just 25 basis points if the market's right at prognosticating.
Yeah, so I guess rate cuts are coming sooner or later. So is that just going to be more tailwinds for markets, with new highs on the cards? What are you expecting for the S&P 500?
So I think the reality is that until we finally have an understanding of what's going to happen with tariffs, especially as it relates to some of our larger trading partners, it's going to be a wild swing in the fall. Right now you're looking at an S&P somewhere in the 6,500 range. You're seeing a lot of firms call for 6,600 being the top, but there being plenty of trading opportunities between here and there to position a portfolio. So for investors who are in it for the long haul, there probably is still some upside here. If you've been in the market and you stood through in April, or maybe used April and the Liberation Day as a buying opportunity, you might consider going into the fall, taking some of that profit off the table. And then again, don't forget that one big beautiful bill is out there, and all the ramifications as it relates to what's going to happen with U.S. tax policy still has to be figured in.
Yeah, plenty of implications on that front to watch out for. And of course, things don't always go in a straight line, so there could be some volatility before we get to the end of the year. So with that in mind, where are you looking at when it comes to opportunities? In the latest session, we did hear Intel in the news because the administration is reportedly looking to get a stake in this chip maker. Is that a space you're looking at, chips and AI?
So chips and AI has been a spectacular theme, especially as you've watched them react and overreact to different tariffs and, as high as 30% and then full exemption. And then you're not allowed to sell chips to China, but okay, now you can as long as the U.S. government takes a 15% cut and only of sort of second generation chips. The reality is that as the United States government figures out what kind of economy it's going to actually be under the Trump administration, is it going to be laissez-faire capitalism and try to privatize, Fannie Mae and Freddie and all of those other quasi-government agencies that it nationalized during the last credit crisis? Or is it going to be the kind of government that takes a stake in Intel and claims that it is some kind of national security issue? It really is 6-1 and pick 'em from this side. I think you've got to look for companies with strong fundamentals who are in those growth kind of markets where they do have opportunities to see expansion on the multiple side in AI. But at some point, you can only watch, NVIDIA and some of those companies continue to deliver that kind of year-over-year growth to the point where it's going to become virtually impossible. They can't grow that big because of the exponential growth that they've seen. So we're very careful to pick our spots. We do want to be careful to be in sort of the larger capitalized part of the marketplace. And we're also telling clients to think about picking dividend payers, right? Get paid to hold the stock while the volatility bounces around, realizing in the United States our tax regime doesn't cost you anything until you actually sell. So go for the ride and get paid to wait.
All right, great snapshot of where things are going, and also a reminder to stay diversified. We've been in conversation with Jason Britton. He is the founder and CIO for Reflection Asset Management. Jason, thanks as always for your time and insights.
Always a pleasure, Ryan. I'm going to go find myself some of that chili crab.
All right, catch you next time. All right, stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.